All right, hey guys. So crazy market that we're in right now. I mean, if you're a global macro swing trader like myself, the fundamentals are really just not driving the market right now, right? Everything is just driven by headlines. We have risk on in one market, and then in the next 20 minutes we have a risk off market. So it's the big issue right now is two things, at least for my type of style, is the risk sentiment, which is caused by headlines, right? So there's a lot of emotion, there's a lot of just craziness going right now. It's very hard to read between the lines. I would say those scalpers, I think, are doing extremely well right now because we're having two types of markets, either trending up with barely any pullbacks or consolidations. Okay. It's just a great time to be a scalper, I would say, because those are um, they're trading kind of on the lower time frames. It's a lot easier to kind of look at price. You're not getting those kind of you're getting a lot of consolidation, essentially channel trading within the high time frames and strong trends within the higher time frames. All right. So for example, I would say ES market, right? E futures, look at that. I mean, there's just barely anything. Look at the daily. I mean, it's just breakouts on top of breakouts on top of breakouts. This is obviously unsustainable, but at least for now, um, this has been amazing. And that's just where we're at right now. Okay. So I was in a AED CHF trade partly because of the interest rate differential, the stronger economic growth overall. Um, there's a lot of bullish indicators, but it's being capped because of the headlines that we're having right now today. So just to kind of go over fairly quickly, I mean, you guys can just search online. I'm sure if you guys read news, you definitely see what's been popping up. But the main issue right now is that the Middle East conflict does not look very positive. The Iran's proposal got rejected by Trump. Um, the markets are kind of neutral to kind of risk off right now. Okay, oil is going up, inflation is going up. We can see yields are elevated. VIX is also a lot higher, which does show where the market is right now. We're a little bit more fear. We're above that 200 EMA or 50 EMA, excuse me, 50 SMA, not EMA. I'm trying to find oil right here. Give me a second. Oil is also elevated. As you can see, we look like we may break out this high. Oil, honestly, to be fair, it looks like a great trade right now. It does look like a really, really great trade. I don't really want to chase it up here, to be honest with you, but it does look like a really nice trade. Um, but yeah, we're tapping into that 200 MA, or we basically, I mean, the 50 has crossed 200 MA, sorry. And we're pulling back, and then now we're kind of breaking up. So to be honest, I wouldn't chase it now at this breakout, but I wouldn't mind looking for a pullback. Um, we'll see, if we can get that. I wouldn't mind just kind of trading a move maybe to the highs. That's something that I may be interested in. I can try to look at the edge finder here, try to see what are the top setups that has been kind of popping up. Uh, US oil is still kind of neutral at this point, which is fine. Um, but if we get a more stronger risk off reading, I'm kind of certain that US oil will likely move higher with bonds also kind of trending up. But right now, like I said, the reason why things are not updating is because the market's kind of neutral, risk off to neutral, right? Or neutral to risk off. But something to take note, right, is we have a lot of news, or very important news that is very pivotal for the market, for the FX market, for just global markets. Okay, so we have CPI, we have PPI, we have retail sales. So look, if we get a hotter than expected reading on CPI, definitely you can expect yields to go up. Okay, the US dollar is going to go up. Obviously, if you guys don't know, the reason being is because and gold is going to crash, not crash, but gold will sell off, is because of the fact that there's better yields, right? If there's high inflation, then there's a good chance that the Fed might, switch their tone from not cutting for the rest of the year to possibly turning to a hawkish stance. I mean, they're kind of in a hawkish stance now, but they have not really been very firm on the fact that they may or may not hike rates, but they have not give a negative view on that either. I mean, if they have to, they will. Um, okay, and US is not it's not the economy that they're in right now. It's not really doing much, but it's not as bad as the Kiwi, Canadian dollar. I would say I would say Kiwi probably because there's elevated inflation, right? It's around 3%, but at the same time, there's weak growth, high unemployment. It's not a good look for New Zealand or for the Kiwi. But the US is kind of, they had positive job report on Friday, but weak wage growth. And at the same time, there was peace talks kind of going on, and so there was a lot of sell on the US dollar because under the risk sentiment at that point was risk on, right? We had also strong earnings, AI spending, semiconductors were moving. It was just that was the kind of market that we were in last week, Friday, or for the week. Um, but initially we had a bit of a USD sell-off because of the weaker wage growth, even though jobs report was positive, but people are actually earning less. And if you look at it from a nominal standpoint, um, the job market has just been selling off for the US. Okay, so labor market, we've just been selling off, guys. That's why, and I think now more and more people are really getting the feeling, at least the real tightness in the job market. But we have been selling off for a very long time, right? Jobs have just been decreasing, right? Like 4 years, right? We had a bit of a perk during that 22 period, but look at what's happening right now, right? Everyone is, the market is really feeling the pain right now. Okay. Um, let's look at wage growth. Same thing. We've just been decreasing, right? So realistically, on a labor markets perspective, we're just not doing really well. I mean, NFP is kind of in between. I mean, we've also been decreasing, obviously, from a nominal standpoint, but as of recent, it's kind of been flat. But look at the NFP, right? Besides this strong perk here, but look at the numbers that we're getting. We're not getting the same numbers as we were during the 2022, 2023 period, even the 2024 period, right? So tough labor market that we're in right now. Okay. So like I said, CPI coming out is going to be extremely, extremely pivotal. If we do get hotter than inflation period, like I said, then definitely expect oil to rise, expect gold to crash or sell off, expect the US dollar to go up, expect bond yields to go up, expect um the market to kind of shift away, expect stocks to fall, right? To sell off a little bit as well. It's going to be very, very important to see what happens. And the game plan. I mean, I'm kind of in between either staying cash or yeah. I mean, I am kind of in between because it's a market that has tons of volatility, but at the same time, it's a market that's very hard to read between the lines. And when you're in those kind of situations, you just want to stay cash. Okay. There's just no point of risking your capital on a market like this. There's just no point because there are clear fundamental divergences, but headlines are just shifting things. Okay. Um, I don't really have I don't have any political agenda or interest, to be honest. That's not how I trade. But that, that's, I mean, the headlines are really fucking everything up, right? So if you're a global macro swing trader and if you feel the same way and you're kind of going through the same stuff as well, highly relatable. I mean, I think for the most part, that's kind of what has been happening for the rest of us. Um, but yeah, going to be very, very interesting to see the CPI results coming in today. Um, As of now, I actually I am in still an AUD shift trade, which was doing relatively all right. It was pretty slow mover until we started to shift to a risk off market, and now we're kind of settling off, right? So, I've been stabbing at this trade for a while now. Really, the main reason is because of the fact that the interest rate differential is super strong. Um, Swiss National Bank's at 0%, RBA is at 4.35%, but it's also a very strong risk on to risk off sentiment currency. So if there's heavy risk off, then AUD is going to crash, sell off, and Swiss franc is actually going to increase. And that's why right now, I mean, currency strength wise, you can see currently the US dollar is taking the lead here, and you can see that Swiss franc is actually higher than AUD. AUD is actually the weakest currency today, right? So yeah, I mean that's just how it is right now. I can show you this was sort of my report on AUD right? I mean it was a very quick write up that I wanted to look at, right? So um, yeah, AUD yields, the interest rate differential is the main reason, right? But I did also mention, and this was I did this write up in the weekend. It comes down to the developments of the U.S. and Iran war, right? Stocks fail, CHF will catch the bid. What will invalidate it is de-escalation and equity rally. You see how this is failing? So I've already kind of mentioned this I've kind of mentioned this kind of before already. And that's what we're having right now. Unfortunately, we're not getting the latter, we're getting the former. We're getting thoughts failing. Swiss franc is actually catching a bit, and we can see that with AED Okay. Um, but yeah, unless the escalation fails, hotter than expected CPI for the US CPI for the US and China talks if it doesn't go smoothly. Yeah, we have talks with China and the US on Wednesday. So I mean, just hedge funds, asset managers, everyone's watching that because definitely, of course, US, one of the agenda is the US is going to start to discuss a little bit more to China on maybe a possible intervention, right? Because China buys like 90% of Iran's oil, so it's basically funding the entire war for them. Um, it's going to be big, right? That's going to be important to take a look at. So, yeah, so CPI today important, tomorrow talks important. So currently right now, I'm just gonna, I mean, I'm not, that's why, I'm not very heavy risk. I don't have heavy risk yet. I think I got about half size. So another thing I do want to mention as well, do not go full on risk in this market. Okay, don't go I mean, depending on what that is for you guys, it could be 1%, could be 2%. If you're a prop firm, probably 1%, maybe half percent. If you are you have your own percent capital, probably 2%. Um, Stay out of that, right? Do not get involved in that. Stay out of that. Stay out of risking on full risk in your positions. Take in smaller size first, get a feel, because likely we're gonna have a lot more stop outs. I think that this few weeks, to be honest with you, I don't have a crystal ball, but that's what's been happening on my end. I have really high out setups, but the headlines are just not aligning with that, right? So yeah, okay.